Hello everyone, I'm Sahil and welcome back to the channel. So as I mentioned in my latest monthly update that I will be covering Ping An again. I made my first video on Ping An, the in-depth company analysis video in February, and since then it went up until March, and since the peak of March it has actually dropped down 18.4%, which is a huge drop, and I think you guys would be somewhat concerned. So yeah, and also recently they released their quarter 1 earnings. So in this video, we will be covering that up, and together with a latest acquisition that they have announced. So yeah, which saw a lot of investors selling off the company. We will be covering these two topics in this video. Since it's my first video doing the quarterly earnings analysis for you guys, I will be covering everything on like the entire process on how I do it. It might be draggy for some people, but I hope that for the majority it gives the insights, and also for the people who are better than me at analyzing stock or something, please let me know how I can improve through the comments below. I would really appreciate that, and I will surely spread the information around through this channel for the others. And throughout the video, if you get any value, please don't forget to like the video. It will really help my channel to grow. And yeah, it's time to hit it up. Alright, so I always start with the numbers first because it gives me a quick overview of what really happened in the past one quarter without getting influenced by the sugar-coated words of the management, which is quite a normal case in the earnings reports because they're trying to maintain their share price, if not boost it. So yeah, it's always good to take a look at the numbers first. And over here, I have pulled off the quarter 1 earnings for past 4 years. This is from Capital IQ, but you can also do it from Yahoo Finance if you would like to. And if we take a look at the numbers, firstly, it's the revenue, which actually grew by 3.3%, which isn't very good growth if you compare it with the pre-pandemic levels, which has been in the high teens for the past 5 years and more. And particularly in 2019, it's 16% growth from 2018. So this quarter 1 performance has been muted, and if you take in consideration that the past year's numbers were already like down because of COVID, so this performance is actually not really good to see, and you get a sense of why the price really dropped. That's something. So yeah, and you can see that revenue numbers itself is actually down 6% from the pre-pandemic levels, which isn't good. I mean, it means that the pandemic is actually still putting pressure on the revenues for Ping An. Also, if you take a look at the individual segments, we can notice that the insurance premiums have actually dropped from the year-over-year numbers. So yeah, we have to figure it out what really happened, because insurance premiums are really the core business for Ping An. So this numbers really means something. Other than that, the other numbers have actually performed better than last year. Moving on to the operating income, so we have a growth of 19.8% compared. Even though like the revenues increase was only 3.3%, this means that the company's management has cut costs somewhere, which is a good thing if they were able to do that sensibly. So yeah, that's a good plus point I see over here. Then going down to the earnings before tax, it has actually grown 3.5%, which actually means something, because it should be in line with the operating income, right? The growth, but it's way below. So something must have happened, and we can actually look down in the individual segments what really changed. So if we see, there's the asset write down, and it has increased pretty steeply this year. So that is again something that we have to take note of, and we can find out what really happened through the earnings report later on. So just pin it down to the side. And then moving on to the net income. Net income grew by 4.4%, which isn't a great number as well. Like if we see the past number again, pre-pandemic levels, 2019 was an outlier. The increase was pretty good, but even in the past, the numbers have been in the high teens. So this again, the performance, we can say that the quarter one performance wasn't up to mark. It was quite muted. I won't be going through the balance sheet and cash flow statement because it doesn't make sense to do analysis on them for such a short period. I would rather do that on an annual basis, so you can wait for the annual report to come out. But just to summarize the entire income statement, we got to find out that the revenue growth wasn't so great. It was quite muted, but the management was able to do something good, and they were able to cut the expenses so that the operating incomes were high. But there was a write down somehow, so we have to figure out why there was a write down, which brought down the net income in the end. Then also there was a drop in the insurance premium, so we have to figure out what really happened in that. So to find out all this, we have to look at the earnings report. So for Ping An, they come up with two things every quarter. Firstly, it's a presentation, and secondly, it's the report itself. So firstly, let's go look at the presentation because it really summarizes everything for us, right? And it would be a quick thing. So let me just get that through. Let's look at the business highlights for quarter one that Ping An presented. So firstly, they said that the operating profit attributed to the shareholders of the parent company increased by 8.9%. Where did this number come from? Like we didn't see it, right, when we are doing our calculation. So let's go back to the income statement and figure out where this number came from. So if you can see over here, it is actually the income from the income to the company. This is before the minority interest. If you want to know what is minority interest, go find out. Just Google. That is not really the net income, but the income to the parent company. Ping An normally just reports this in their highlights, so it's consistent with the past year earnings report and not something they are actually trying to hide or something. Secondly, we have the retail customer, which totaled at 220 million at the end of first quarter. At the start of first quarter, it was at 218 million. So this is an increase of 2 million in the 3 months. In the same period last year, it increased by 4 million, and the year before it increased by 6 million. So we can see a slowdown over here. Also, the percentage customers with multiple contracts increased to 38.3%, which is an increase of 0.3 percentage point. Last year, in the same period, it increased by 0.2 percentage point, and not a big thing. This is actually a cross-selling aspect of the cross-selling of the in between the businesses, and it was quite significant in the corporate side, where we saw a 24.5% increase in the premiums attributed by cross-selling. And also the NBV, the new business value, increased by 15.4% in the 3 quarters, which is a comeback from the last year's drop of 24.4% due to COVID lockdown. So the businesses were not really bothered to buy insurance during that time, right? However, the NBV margins has seen a drop of 2 percentage points to 31.4%. And also, if we compare this with the year before, we are still down by about 12%. And what is this new rollout about? We can find out later in the earnings report as well. Let's add to the things, the few things that we pinned to the side. Nextly, we have the property and casualty business and the combined ratio. Combined ratio is incurred losses plus expenses divided by earned premiums. And this is a profitability margin that we use to compare different insurance companies. It is very similar to net margins, but in the net margins, you take the net earnings divided by the revenue, right? So on the other hand, for the combined ratio, you're using the expenses divided by the revenue. So we want the expenses to be lower, right? Hence, the lower the combined ratio, the better it is. So for Ping An, they actually managed to decrease the combined ratio. So it was at 95.2%, and the previous, the quarter 1 2020, it was at 96.5%. So this is a very good increase, and actually a very, very good number compared to other insurance companies, which are normally around 98 to 99% level. Okay, and then we have the banking segment. For the banking segment, the net profit showed an increase of 15.4%, which is a very good performance. Last year it was at 14.4% increase, and the year before it was at 12.9% increase. This is a very good thing again. Lastly, for the highlights, the non-performing loans, which are loans that the borrowers are overdue on by 90 days. For Ping An, the NPL shot up last year due to COVID and was at 1.65%. Now it's down to 1.10%, which is amazing if you compare it with other banks out there. Like in Singapore, the three Singaporean banks, their NPL ratio is 1.5%, consistent for all three. So Ping An is really an outlier in this and a good company in this. The good combined ratio and good NPL is actually achieved by their commitment to AI and all the tech that they're using to analyze their customers before they are underwriting them insurance or providing them with loan. So this is super cool, and we can actually see it working for them, and it's not just some cool gadgety shit. Let's move on to their quarterly report now to find out the answers to the questions we had. Okay, so basically the report actually covers all what is in the presentation and adds to it. So if you want to find out, I actually already found out what was the thing, so I'm gonna just go and scroll down to it. So here it is. Ping An made provision for impairment losses and adjustment of valuation of investment related to China Fortune Land Development. The impairment provisions total about 18.2 billion RMB. So what is this China Fortune Land Development? Well, I did some digging for you guys, and it happened to be a property development company, no surprise, and a first victim to the 3 red line policy that the Chinese regulators came up with. So China's property market is actually very heated, and it's really well known that it's overly leveraged and probably in a bubble. So to cool it down, Chinese regulator put a cap on the amount of debt that these property development companies can take on. So since China Fortune Land Development had a lot of debt and they couldn't refinance enough to pay it off, they actually defaulted on a $530 million bond this March. Ping An has a total exposure of 54 billion yuan in China Fortune, with over 18 billion in equity investment and 36 billion in debt. In the big picture, like Ping An has a total investment portfolio of 8 trillion yuan, so it is merely like 0.675% of the total investment. But nevertheless, it did have a negative impact on their net profits this quarter of about 2.9 billion RMB after tax. Now, China Fortune isn't bankrupt yet. It is raising money through equity and also have some outstanding revenue from the government. So it was building some parks and stuff for the government, which they have not been paid for. So let's see, Ping An has already written off their entire equity investment portion of the exposure. So let's see what happened in the next quarter related to this. And it is a kind of a risk that all the investors are perceiving now, because there could be more exposure into the property development sector from Ping An, which could have negative impact going forward. So that could be one of the reasons why we are seeing the price dropping. Now, the second thing we wanted to find out is the new comprehensive rollout that they mentioned in their highlights. So we can find it out over here. They have mentioned. So to summarize all this, it's basically about their sales channel and product strategy which they are calling 1+4. So for the sales channel, right, they are focused in a digital transformation. From recruiting agents to training them, everything would be digital. This is to boost the operational efficiency and decrease the expenses. How much it does so, we would have to find out in the future, but it is taken as a positive, and it is something that they have been planning for past some time now, and it is it is on target so far. In terms of the product, they are actually making a competitive moat around their ecosystem. They have merged multiple services into one and are actually providing dedicated family doctors to every insurance holder, that life insurance holder that they have, and also providing services from basic health management to elderly care. This combined with their health insurance make makes it like, the app is connected to their health insurance, so all the expenses are automatically deducted, and they also know what is covered and what is not covered before making a decision to go on with the procedure or whatever treatment they are taking. So yeah, it makes the entire experience really hassle free and very convenient. So this is something that would attract customers going forward. And I think a lot of people have, even living in Singapore, we have trouble understanding the insurance products and what is covered and what is not covered. And it is only at the last time that we figure it out, and we are not able to use all the advantages of what our insurance coverage provides. So yeah, this is something that is really good, and China is really advancing in this sector, with Ping An taking the lead. So let's move on to the property and casualty segment. Now here we can see a drop of 8.8%. This is the one that is now responsible for the overall drop in the insurance premium that we noted and we wanted to figure out, right? Here is our answer. But what really happened? Ping An says that it is due to the reforms in the auto insurance by the regulators. Now, Ping An was able to improve on the profit margins with enhanced risk screening, which is very impressive, and that is why they were able to improve the combined ratio. And it is all a showcase of their AI tech and that they have been using to actually assess the driving behaviors of their customers. And adjusting their insurance premiums accordingly. All right, so that's it for the quarter one earnings, but let me just summarize everything once again. So we saw that the earnings were muted this quarter, which is not a good thing, and however, Ping An managed to reduce its expenses while increasing the profitability of their property and casualty business. The new business value also saw amazing growth, however, still below the pre-pandemic level. The earnings in the end also suffered from the impairment losses of China Fortune, and overall the pandemic is still seems to be depressing Ping An's growth. However, I feel that going forward things will be better since there is an increased awareness of having health insurance, and also together with the government's push of increasing the penetration, we will see good momentum going forward for Ping An. Now, also to add on to the earnings, right, Ping An announced that they will be buying 51 to 70% of New Founders Group, which is valued at 11.3 billion US dollars. What is this New Founders Group and why is Ping An buying it? Let's figure it out. So New Founder Group is a new entity that is formed by combining all the assets from the Founders Group, which was a state-owned conglomerate and founded by the Peking University. I don't know if I'm pronouncing it right, but it is a famous university in China and has been under judicial restructuring since July 2020 after going bankrupt. Their key assets under the new entity are of four main segments: healthcare, tech, finance, and education. Now, three of the four segments are where Ping An has its business, so it makes it more clear for us why Ping An is actually taking over this business. The takeover is really commercially driven to strengthen their healthcare ecosystem. Investor took this decision as a negative, apparently, from the sell-off that we saw after the news came out. But let's take a look at both the positives and negative and have our own opinion on this. On the positive side, adding the flagship hospital, the Peking University International Hospital, and 10 other healthcare institutions with over 10,000 plus hospital beds suggests a potential for business scope extension, that is healthcare insurance, patient information, and medical claims control as one value chain. And secondly, the investment case is based on asset sale and takeover instead of capital injection into the bankrupt company. So there is a limited further capital deployment potential post acquisition, which is a great thing that they are doing. And this restructuring is in favor of Ping An. They don't really have to spend more money afterwards to pay off the lenders. So yeah. On the other hand, according to JP Morgan, the investment might be better welcomed if Ping An Group were to issue hybrid debt or use their own excess capital for it, as the company does not fully utilize leverage at the group level. So for the same reason, it is expected that the marginally negative impact on Ping An Life and Ping An Group's solvency ratios. However, if you see at the moment, right, the solvency ratio for both Ping An as a group and Ping An Life is about 2.3 to 2.5x of what is the legal requirement, which is a huge margin for them to play around. So this will have very minimum, it really doesn't bother me as an investor. Also, it should have very small impact on the financial numbers like earnings and dividends. So yeah, it really, I personally see it as a positive because of the amount of assets they are adding and how good it gels with their ecosystem. So they are able to expand their synergy. Net, I'm positive about this news, and if someone over here viewing this has something to add on, which I don't see, please feel free to do that in the comments below and enlighten me plus the rest of the viewers. So now in the end, the question stands: is it a good time to buy Ping An Group? Now the price is around 18 Hong Kong dollars, and my personal price target for Ping An in my previous evaluation was around 108 Hong Kong dollars. So it is at a great discount of about 30%. Around 30%. It has also already touched the negative one standard deviation on the price to enterprise value chart, which is a good sign that it is somewhere at the bottom. It could go down, but it is really something where you should actually start buying. Also, on 6th of May, the CEOs, the insiders actually bought, if I'm not wrong, around 700,000 shares in total. I think there were like 3 insiders that bought, including the CEOs and co-CEOs. So yeah, they are buying it they bought it around 85 Hong Kong dollars. So definitely at the current price level, it is a better buy. You're buying it lower than what the insiders bought it at, which is a good sign. They know more than the company than any other know. They also have the bias, but they have forward-looking numbers. So if they are buying, obviously it's a good sign, and you should buy as well. I actually bought yesterday one lot of 500 shares at $81.10 per share for my dad, not for myself, because I'm already out of cash and I can't really afford it. One lot of Ping An is huge. It's like 7,000 Singapore dollars. So yeah, that's it for today. I hope you got something out of this, and until the next video, ciao.